Well, hi everyone, Shaun Humphries here. Welcome to All Things Retirement. Well, in this video, we're going to talk about inflation. It's been a big part of conversations over the last year as inflation began to ramp up and people had to cope with it. And one of the biggest impacts, of course, has been the response by central banks to raise interest rates. Probably one of the most violent series of interest rate hikes over a short period of time that we've ever seen. So how should inflation affect retirement withdrawal rates? So inflation is something you need to be factoring into your retirement planning before you retire. In other words, before you retire, you need to model different inflation rates to see how bulletproof your overall retirement plan will be. Now that you're retired, if you're actually beginning to take cash flow from your portfolio, you want to be very cautious about how you draw down income depending on the on-the-ground events that you're experiencing from an inflationary standpoint. So clearly, just using rules of thumb and the analysis you put together 2 years ago is not good enough. You need to consider potentially readjusting your expectations around income until we get through this very strong inflationary period. So we'll cover that off in a little more detail in this video. So if you're new to our channel, make sure you hit the subscribe button. We're posting content all the time on various aspects of retirement income planning and overall wealth planning. If you don't want to miss future content, make sure you hit subscribe. As well, if you go to the show notes, you can find resources to various free educational programs we put together. And if you want to find out how you can get your own complimentary retirement plan, whether you're getting ready to retire or maybe already retired, you want some just a double check, some peace of mind about how you're tracking, go to the show notes. The link will take you to our website where you can find out how you can get that complimentary plan. Okay, so is course correction necessary? What are the impacts of inflation over this last year on your overall retirement income plan? Now, before we talk about how you should respond to this inflationary environment in the context of your retirement planning, cash flow planning, I think it's important we set some context. So this slide we put together a while ago, but it was beginning to discuss the inflationary headwinds. We knew that because of supply chain interruption, labor market disruption, massive government spending, in fact, that one's crazy, average household income was actually higher based on Stats Canada data in 2020 and 2021 than 2019. That's how much money was pumped back into the economy through government subsidies. Central banks increased money supply principally by pushing down interest rates to almost zero, and then the opening of economies in advance of capacity would be inflationary. So you take all those issues. We knew that when people were able to spend, buy, consume goods and services, travel more, that would be inflationary because the global economy would not be able to open up quickly enough to deal with that pressure. So too much money pursuing too few goods and services is by definition inflationary. And then on top of that, the tragic war in Ukraine, which put rocket fuel on the inflationary fires. And so all these things have conspired to raise inflationary pressure and inflation. Now, fortunately, we've seen inflationary pressure coming down, but it has been, stubbornly resilient in certain categories. Now, we do think that the trajectory is that, inflationary pressures will come down. Central banks are likely close to a peak in terms of interest rate policy, and that for a lot of other reasons, principally demographic reasons and others, we'll see declining interest rates in the overall economy. So that's been the history. And now that we're in the midst of trying to cope with inflationary pressure, what should our decision tree be around different trade-off decisions around handling inflation? Obviously, we're having to take potentially more money out of our portfolios to generate the same purchasing power from a spending standpoint through our retirement years, at least in the current context. So let's take a look at a few strategies or ideas to sort of give you a bit of a planning template for how you want to look at this current inflationary situation that we're in. Now, the first idea or strategy that you want to really take to heart is don't overreact. So there's no doubt that anxiety can come up when you go through an environment like this. We haven't seen an inflationary uptick like this for an awful long time. So I'm going to give you a couple of ideas in terms of how you respond to this. So first of all, this is not going to be a long-term structural change in your spending. Inflation is not likely to stay at the current levels. The higher probability is that it's going to come down. In fact, we've already seen inflationary pressure come down quite a bit in the last few months. Now, it's saying that you do want to take into account on your cash flow and spending game plan the inflationary pressures as they are right now. So if you do your own financial planning for cash flow and retirement, or you work with an advisor, it's prudent you sit down and just model for the next year or two at least some higher expenditure trends because of the inflationary pressure. I think it's reasonable to expect that rates will go down. In fact, the Financial Planning Institute in Canada came out with guidelines for long-term inflation planning, and their guideline was a 2.1% long-term inflation rate. Now, in our practice, we're using a higher rate than that. We're using 3%. But when we look at various inflation assumptions and what economists are saying, inflation will come down, and there's a lot of reasons for that. One is demographics. I'm not going to get into that discussion in any detail today, but factor in the higher costs today, or take a look at those costs that are more inflationary, and maybe you can cut back on those costs. You're not going to come back on your basic non-discretionary expenses. You've got to pay for your accommodations and your food and utility bills. There's various expenses that just aren't going to go away, but you might have other expenses for travel, entertainment, hobbies that are more inflationary. Maybe you pull back a little bit on those expenses to get through the inflationary period. So number one option is model higher expenses for the next couple of years, build that into your model, see how your plan is resilient around that, or a combination of that and cutting back on some of those more inflationary costs that you might experience. And like I said, don't panic. This is not a long-term scenario that you have to worry about. Okay, now strategy 2, or the second idea, is age is a factor in this whole discussion. So the older you are, the more probably capacity you have to deal with inflationary pressures. So if you're in your late 70s to early to mid 80s, given life expectancy, you don't have to cope with those inflationary pressures as long. I know it sounds kind of crass, but that's the reality. So if you're older in retirement, yes, it's unnerving, but likely when you start rolling the inflationary impact, even a multi-year impact, if you've done a decent job in your planning, you're probably fine. So that category of retiree probably has a little more buffer in their planning. But if you're younger, if you're in the early stages of your retirement journey, you need to be much more cautious. You can't be cavalier and just assume that you can keep spending at constant rates, dealing with inflationary pressure, and then 6 years later you realize you've gone through way more retirement capital than you anticipated. So you do need to course correct or make adjustments to cope with inflationary pressure. Again, hopefully it's a short-term phenomenon, but you need to be much more intentional in your planning the younger you are in that retirement journey. Okay, the next strategy is you need to stress test your retirement plan. This should be done on a regular basis, but it's even more vital that you do it before you retire. So ideally, you're now in the runway phase of retirement planning. You're within 5 years of retirement. And stress testing basically looks at your retirement plan with variability attached to it. Variability of investment return, variability of inflation rate in the context of a steady drawdown from your portfolio for income. Sometimes it's referred to as a Monte Carlo analysis. So it's basically creating this variability which mimics more of the real world, right? So when you look at a lot of retirement income plans, there are sort of these static assumptions. Here's what I'm going to make in my portfolio. Here's the inflation rate. Here's my income. Am I on track? But life never works that way. Life is full of variability. And so stress testing your retirement plan in advance is very, very helpful because it gives you an idea of how bulletproof your planning is. Now, if you've never done a Monte Carlo analysis for your retirement plan or a variability test, then make sure you go to the show notes. There's a link that will take you back to our website where you can find out how you can get a complimentary retirement income plan. And as part of that planning process, we're able to provide you with that stress testing model just to see how bulletproof your overall plan is. Now, you're in retirement or very close to it, and you're going to draw down cash flow. Another strategy that attempts, and I think it's a pretty good strategy, of dealing with uncertainties is the 3-bucket approach or income wedge approach. And you've probably heard about this strategy from me in previous videos, but essentially what you do is you do your retirement income plan, you get very precise in your cash flow requirements, and then you put in place in your plan as a sort of a safe harbor part of your portfolio that is earmarked for money that will generate retirement income. Now that safe harbor portfolio may not be used right away, but essentially what you're doing is you're looking at your retirement plan, you've dialed in how much money you need to draw from your portfolio to subsidize other forms of pensions. Ideally, you want to have anywhere from 2 to 3 years worth of pension income or income supplement built into your plan that could be invested in high-yield savings accounts, money market accounts, T-bills, GICs, very conservative investments. That's set off to the side as your safe harbor insurance policy in case markets don't do well. So if you go through this variability of return period where you need more money from your portfolio or you have to cope with market volatility, you've got this money set aside just in case. Well, it's my hope that you found this video helpful. Some strategies to cope with the current inflationary environment that we're in and some of the planning tips that you need to give consideration to. Now, if you're looking to get a stress test, retirement income planning analysis, just to make sure you're tracking in the right direction, again, go to the show notes. There's a link to our website so you can find out how to get that complimentary plan. And there's also links to free resources that you can take advantage of. And if you haven't subscribed yet, make sure you do that so you don't miss future content that we're posting on a regular basis. Anyway, wishing you all the best in your retirement and overall wealth planning journey. You take care. Bye-bye.